This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, top banking insider's dire warning rocks the financial world. And you're not going to believe what he said and what he thinks is coming for the U.S. economy. Plus, policymakers in the world's second largest economy are panicking as its economy continues its downward spiral. And are we about to see a repeat of the 1980s? And no, I'm not referring to all the good parts. And if you're wondering what we're doing in Richmond, Virginia today, let's just say there's more problems in the manufacturing sector than many of the experts even believed. And with that, let's head over to the Richmond Fed, who's got their survey of service sector activity. And here we can see their activity deteriorated. Now, that's an important word because what have we been told? That we're going to see a revival in the global economy. We're going to see a soft landing, and that the U.S. manufacturing sector was going to lead and follow the services sector out of this slump and then take over. And what did we tell you? We're going to see further deterioration, further weakness. And sure enough, now we see that coming out of Richmond, according to the survey by the Federal Reserve Bank there. The revenues index dropped to minus 11, while the demand index, this is critical, fell from 10 in September to 0 in October. And what did we make the case? We said demand from U.S. consumers is coming down. They don't have the pandemic stimulus anymore. Their minimum payments on their credit cards are going up. And they've got to now deal with the fact that student loan repayments are back. They've got a lot of headwinds, and we've been seeing in the global trade data that demand wasn't all that strong. And then adding on to the fact, everyone believed the U.S. manufacturing sector was immune. We said hold tight. The strong dollar is going to cause a problem, and now we're seeing it. And what we note is expectations index for future revenue and demand also decreased. This is a little different than the Philly Fed, who, if we saw, well, they were a little optimistic. And although they remained in positive territory, firms grew more pessimistic about local business conditions as that index fell from minus 5 in September to minus 15 in October. The index for expected local business conditions also declined to minus 22 in October. So here you get this pretty gloomy report that says, hey, you know what? The manufacturing sector in the Richmond, Virginia area is slowing down, and that's not a good sign. And so what you would expect is none of them not to say what they just did on the next paragraph. The employment index increased from 3 in September to 15 in October, while firms continue to report wage increases and little change in their ability to find workers with the necessary skills. And over the next 6 months, many firms expect to continue hiring and anticipate some improvement in their ability to find workers with the necessary skills. And while most firms plan to continue wage increases, so, you wouldn't think about that. If a business is saying, look, our outlook right now is not that good. In fact, our future outlook isn't that good. But by the way, we're going to keep hiring people and giving them pay raises. There's a disconnect here. And sure enough, we see that disconnect further down in the data as average growth in prices paid increased, while the average growth in prices received decreased slightly in October. Firms expect both growth rates to moderate over the coming year. Now, there's the problem, because let's look at the actual numbers here. And this is what matters. Look at price trends. You see down here, current conditions. Price trends are rising. So we're seeing inflation in the U.S. factory sector. But normally, look at this. Prices received, they actually are going down now. So what is that telling you? Is that these firms are being squeezed at the margin, and that would not make any sense as to why they would be hiring people if they had some belief that prices they're receiving are going to go higher. The challenge here is we know they're not, because demand is coming down. So we're seeing this now, and the regional Fed data. Now, will it make it to, of course, the headline government data? Well, probably at some point with a lag. But right now, what we can see, demand is indeed coming down. And of course, we look at this as a global shortage of dollars. We've talked about this before, as central bankers are curtailing the growth of money because they're keeping the banks in a position where they cannot make profitable loans. So less money originated by the banking system, you're going to see a broad-based slowdown. And now we have another dollar-denominated loan goes into default. As China developer Country Garden deemed in default on dollar bond for the first time, we said this was coming, and of course, so did they. The builder along the world's most indebted developers didn't pay $15.4 million of dollar bond interest by the end of his 30-day grace period after missing the initial deadline back on September 17th. A default appeared all but official after Country Garden told Bloomberg last week didn't expect to meet all of its offshore payment obligations on time. So they admitted it. Hey, look, we don't have enough dollars. And then what did we see out of China? They were selling treasuries. And everyone said, oh, they're doing it to prop their currency up. No, the answer is they need dollars. That's exactly how the global monetary system works. Foreign central banks accumulate dollars. They convert those dollars to treasuries. And the goal over time is to accumulate more and more U.S. treasuries. It's kind of what gold was during the gold standard. But the problem is, when you are short dollars, you sell those treasuries to get them. Of course, Country Garden obviously wasn't a recipient of those dollars at all. The company is now likely headed for what would be one of the nation's biggest ever restructurings, and of course it would, because the choice for investors is get nothing or you accept our terms. And Chinese authorities have been seeking to revive the real estate market after developers suffered record defaults as debt crisis heads into its fourth year. The problems began in 2020 when authorities laid out 3 red lines, and those rules set leverage benchmarks for builders if they wanted to borrow more money. And sure enough, what did the Chinese government do? They used legislation to curtail the growth of money. And now the property sector is crumbling. And of course, that means the banking sector is crumbling. This is exactly what happens every time when either central bankers or governments inflate a massive bubble, whether it's through direct printing or through expansion of credit, and then they think, wait a minute, we went too far, we're going to need a little air out of this. It doesn't work. The bubble eventually gets popped, and as you can see, China is on the brink of that now. Some prospective home buyers have held back on purchases due to fears that builders might not be able to complete construction, which is exactly what we've been saying they're going to do. And now we have the evidence. Indeed, that is what's going on, which is underscoring the depth of problems. As Country Garden recently said, September contracted sales tumbled by 81% from a year earlier. That's not just some prospective buyers. That's pretty much most of prospective buyers have said, hey, you know what? We're not touching this. And we know the Country Garden, the other developers facing major issues. This all stems back to the Chinese banking system. We know at some point the collapse in the real estate developers hits the banking system and it spreads throughout the world. And if you don't think the policymakers there know it, well, they're panicking in a big way. As she makes unprecedented central bank visit and sign of focus on the economy, and while details of visit weren't immediately clear, well, when the president shows up at the central bank, should be pretty obvious he's not happy about something. Xi's movements are closely monitored by investors for potential policy signals as the most powerful leader. And since Mao has never appeared at the PBOC, according to records, and his visit would highlight recent Communist Party rhetoric on its centralized and unified leadership over the financial industry. Previous such inspections were often led by the nation's premiers or their deputies because it wasn't an inspection. He was trying to make a point. You think back to former President Trump's term in office, and you may remember at one point he called in, of course, then Fed Chair, who is still Fed Chair, Jerome Powell, and everyone was shocked because presidents almost never ever have a meeting with a sitting Fed chief. He calls him in there. And of course, what do we know? He had been tweeting in public and commenting, stop the quantitative tightening, cut rates. And so everybody was on pins and needles thinking, is a president going to force a Fed chief to do anything? Well, of course, as we know, Fed Chair Powell said, hey, I stand behind the numbers. Of course, we know the numbers aren't that real, but nevertheless, he said, I stand behind the data. This is the way it's going to be. Former President Trump didn't get any reaction out of him, but what you see here in China is something similar to that, where you have the president going into the central bank to try to let them know that, hey, what you're doing isn't working, and I need you to do something else here, and nevertheless, it didn't work. As Xi's president reinforces a string of recent moves by the government to boost growth and stabilize markets. And sometimes that can happen without making any policy change, just by walking in there and saying, hey, you know what? I'm watching you. Maybe they'll make a change in the future meetings. It could help ease concerns among some investors that the president had been neglecting the economy amid a purge of senior ministers and a volatile relationship with the U.S. And then meanwhile, China rolls out the bold stimulus. So you think about this, the president goes to, the central bank. Nothing happens. In fact, the market rallied a little bit and then came back down. And so what do you expect happens next? Well, you got it. Here comes the stimulus, only to see market rally fizzle. But one thing that shouldn't be fizzling, my friends, that's your trading account, because if you had our CTA Time Pro or Momentum Time Pro reports, you too could be capitalizing on opportunities. This is our machine positioning report. You've seen it before, CTA Time Pro. Look at gold back on October 12th. We tell our subscribers, we show them twice a week when you find something at minus 100% across the board and it short covers on our fast algorithm, that's your signal. If you want confirmation, you sign up for a Momentum Time Pro. It uses technical signals. On the same day, it went from a bunch of string of cells to a technical one-day buy signal that gave you all the confirmation you needed. You put the trade on right here, this little green ticker here. You throw a stop loss underneath there somewhere where you're comfortable. Had you made that trade, followed our reports, you'd be up right now 5.9%. Meanwhile, as the equity market, as we know, is struggling, and of course the Chinese markets continue to crumble even amid more stimulus. Now, to get both reports right now, links in the description below. And as fans to you, I am giving you both, all of you, a 1 month free subscription. Both, there's a limited number of those coupons, so grab it. You can try them both out for a whole month. Find the signals. You'll see one trade, pay for your subscription for a year. Jump on it now. As told today, China took the first official step to a powerful fiscal stimulus when China's legislature announced it would issue 1 trillion yuan, or 137 billion, of special treasury bonds during the fourth quarter, expanding budgeted fiscal deficit rates to around 3.8% a year. Now, you might say that's not a big deal. Well, it's above the 3% rate they set in March, which the government has generally considered a red line limit for the nation. So what they did is they go out to local governments and they say, look, you're going to borrow more money, and that means you got to go spend it. And that's the goal. They have spending targets, borrowing targets, and they got to spend that money. That's how they do fiscal stimulus in China. Meanwhile, relevant authorities should make preparations for the sovereign bond issuance and projects. See, there you go. Spend the money in an active and orderly manner to ensure every penny is managed and used appropriately to drive the economy. And such was the price action that was greeted by the government's latest push to boost growth, which involved a rare increase in the budget deficit ratio and President Xi Jinping's unprecedented visit to the central bank. And get this, the rally lost steam less than an hour after the market opened, and the main equity indices ended Wednesday with only modest gains. And why is that? Because one, you continue to take on more debt when you're already indebted and you don't get a lot of fiscal push for it. That's a problem. Second issue is China doesn't generate enough internal demand. They're relying on the rest of the world. And we know global growth is slowing. Now, are we about to see a repeat of the 1980s here in the U.S.? And no, I'm not talking about all the good things from the 80s. I'm talking about the double-dip recession. The last time the U.S. yield rose so much, it sank the economy twice. 10-year Treasury yields, a key baseline for the cost of money across the financial system, has jumped, briefly pushing it over 5% in overnight trading for the first time since 2007. It's the biggest increase since the run-up in the early 1980s, when Paul Volcker's efforts to slay inflation pushed the 10-year yield to nearly a whopping 16%. Of course, we know Fed Chair Powell is following Volcker's game plan here: drive rates up, fast and aggressive, kill inflation. Of course, he doesn't know it's going to kill the economy too. In the 1980s, the monetary policy onslaught set off 2 recessions. Now the economy has continued to defy pessimistic forecasts, mainly due to all the pandemic money, with the Atlanta Fed's estimates showing that in the third quarter is likely even gained steam. Of course, we know that was a tail end of the pandemic money. We know consumers went out and used their credit cards. That's coming to an end, but nevertheless, we have to promote what was good before it goes really bad. And of course, policy was more restrictive during the Volcker era because they think that has everything to do with how high yields went. Adjusted for consumer price increases, the real 10-year Treasury yield, or what it paid after inflation, was around 4% by the time the second downturn of the period started in the mid-1981, and now it's around 1%. which is still going to be a pretty good deal as we look into what this top banking insider said and what's coming. You're going to say, wow, maybe 1% yield is actually good, because looking back, it wasn't the fact that Volcker raised rates, and that is the biggest misconception, had everything to do with the bond market not buying into it. The long end of the curve, the intermediate end of the curve said, you know what, Fed chief, you raise rates, we don't buy it. The economy can't handle it. And sure enough, you get this thing called an inverted yield curve. This is a 10-year, 2-year. When it's underneath the black line, it means 2-year yields are higher than 10-year. And if you're saying that's not normal, that's because man intervenes in the bond market and decides what should be. And the bond market says, no, you're wrong. And in fact, they were. And so what happened is we have this massively inverted yield curve. In fact, it inverted twice. There's your double dip recession right on cue with what the yield curve tells us. And now we have the steepest inversion since the 1980s. And yet this time, nobody thinks anything bad is coming, except one person for sure, other than me. And that is, of course, the CEO of JP Morgan Chase. And Jamie Dimon criticizes central banks for getting forecasts wrong. Well, it shouldn't actually be hard to do, because their track record is, well, horrible. In fact, their track record is so bad, they've never actually gotten it right once in history. So the fact is, whatever the Fed is doing, you should just bet opposite of them, because eventually you're going to be right. And fiscal spending is more than it's ever been in peacetime, and there's this omnipotent feeling that central banks and governments can manage through all this stuff, he said. I am cautious about what will happen next year. So what he's telling us here, this dire warning, and he's got it right, because if you look at Keynesian economics and what you should be doing in times when you're seeing an expansion in a booming economy, governments should actually ideally run surpluses and use that surplus to pay back a lot of that debt issued during the downturn. That's what they should do. Now, that's not what we do actually do. You know that. We don't do that. In fact, right now, we're running massive deficits. And even to the point, Jamie Dimon's still saying, look, maybe we should cut our spending back. Even if we don't run a surplus here, we need to cut it back, because when we do have a recession, we're not going to have the ability to go out and borrow money and get through it this time. It's going to be a huge problem. And Dimon likened today's situation to that of the global economy in the 1970s, with high spending and lots of wastage that brushed off the impact of further rate hikes. Of course, we disagree with that part. We know the government's just largely wasteful in the spending. It took on a lot of debt during the pandemic, and now due to higher rates, has to pay more for it. But that's not the issue here. The real problem is the government should be moderating its spending in a big way. It's not. And what it does, when the government borrows money, it pulls money away from private industry. It competes with it. A lot of people don't understand that. You wonder why private industry grows more when the government spends less? It's because they're not intervening in the markets as much. They're not intervening in the economy. They're not pulling money away from it. That's why you see during boom times when governments cut their spending, the economy does really well for long periods. But right now, in addition to all the other factors, the government's choking out what little growth there is until it all comes crumbling down. And I don't think it makes a difference whether rates go up 25 basis points or more, or the whole curve goes up 100 basis points. Be prepared for it, he says. I don't know if it's going to happen. Now, what he's suggesting here is a curve rising due to higher interest rates. And Jamie Dimon, he is a really smart guy. So sometimes you have to look past what he's suggesting here. And he's trying to tell people you can still short the bond market. But what do we know? That these asset managers and big banks are taking the opposite end of the bet, because he knows exactly what's going to happen. And it's going to be that rates come down, and they're going to come down in a big way. And like every other cycle, they'll have to make new lows to get people to borrow money. And sure enough, how do we know? Because he runs a bank. And what is he doing at his bank? Well, here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in red against the 2-year, 10-year yield curve. And when you see that red line, that's banks tightening lending standards above the black line, they're curtailing the growth of money by not issuing as many loans. And when that happens, the yield curve you see in blue eventually goes up. And when it goes up, it doesn't mean rates rise. It means that 2-year yields are falling faster than 10-year, and that means rates are falling. So he's kind of talking out both sides of his mouth here, suggesting that maybe rates rise when he actually knows they're coming down in a big way. And the strongest U.S. economic growth since 2021 puts the Fed in a tough spot. It actually doesn't put the Fed in a tough spot because we know they want to keep hiking. In reality, there's going to be a point where the U.S. economy runs out of money, enough money to continue keeping the growth engine running, to keep all the debt being paid, and it's going to slam into the wall. The only decision the Fed will make is how fast they get back to zero. As the U.S. consumer has been surprising most predictions, including the Federal Reserve, which is almost looking for the U.S. consumer to soften. And yet they don't, but they will. They're out of pandemic money. It's coming. A strong job market is still propelling consumer spending, and business activity is gaining momentum. And if what we can see is additional signs of persistently strong growth can put further progress on inflation at risk. It could warrant further tightening of monetary policy. Of course, Powell actually knows what the yield curve means, and he knows that this isn't likely to happen, but he desperately wants inflation to get down fast so he can stop raising rates. He knows he's threading a needle here. He knows one more hike could tip it over. He doesn't want to be on blame for this. He doesn't want to be on record as the one that tipped the economy into recession. And yet we see the Fed chief signal that policymakers are likely to hold rates steady at their next meeting, that coming here next week, while leaving the door open for another increase in the future as they hope and pray to the monetary gods that somehow inflation comes down so they can keep rates steady and may even cut them at some point. And a lot of this seems to be driven by consumer spending on discretionary items and discretionary services. We think that's a temporary boost. Yeah, you bet it is. When consumers don't have pandemic stimulus anymore and their credit cards are maxed out, which they're pretty close to, the discretionary spend is going to go away. It's also likely to be temporary. A forecasted decline in imports and a rise in inventories last quarter, two developments that we've talked about on the show that economists say were surprising given the strength of consumer demand and are thus unlikely to be replicated in the final 3 months of 2023. In reality, we're going to see imports continue to fall. We're going to see inventories continue to rise as the U.S. consumer gets completely tapped out. And then you're going to watch one country by another is going to hit a wall. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.